Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Each year in June, the reconstitution of the Russell indexes take place in what's called the Russell Reconstitution. On June 23rd, 2023, about $12.1 trillion in investor assets will be rebalanced. Last year, over 3.3 billion shares and $63.8 billion were traded at the close of the Russell Reconstitution, executed in the Nasdaq Closing Cross in just 2.04 seconds across Nasdaq-listed securities. After markets close on Friday, June 23rd, the changes become final and the updated indexes begin running Monday, June 26th, when markets open. For the 20th consecutive year, the Nasdaq Closing Cross will be used to rebalance Nasdaq-listed securities in the entire family of Russell U.S. indexes. The rebalance is designed to ensure that the Russell U.S. indexes continue to accurately reflect the ever-changing state of the U.S. equity market and its segments. Joining me to discuss the importance of the Russell Reconstitution to the market and investors are Michael Sokoll, Senior Managing Director at Nasdaq, Catherine Yoshimoto, Director of Product Management at FTSE Russell, Simeon Hyman, Global Investment Strategist at ProShares, and Steven DeSanctis, Head of U.S. Small and Mid-Cap Research at Jefferies. It is great to have you all back with us for our annual Russell Reconstitution panel, our first time back since COVID, so it's great to have everyone in studio with us. And Catherine, I'm going to start with you. Why is the Russell Reconstitution so important for the market and investors?
Well, you described it well, Jill. There are a lot of assets tracking the Russell indexes. And in terms of the size of the trade on Reconstitution Day, there's expected to be a lot of trading. It is one of the biggest trading days in the U.S. equity market. So it is important that the indexes are also rebalanced to make sure that the changes that have occurred since the last Reconstitution are reflected. So there's a lot going on this day, and it's all part of our accurate representation of the U.S. equity markets through the Russell indexes.
What are some of the major changes that are happening this year?
Some of the major changes in terms of sectors, you might think of healthcare. Has the highest number of companies moving up from the Russell 2000 to the Russell 1000. Similarly, the highest number of companies moving up from the Russell Microcap Index into the Russell 2000 is also coming from healthcare. So healthcare is seeing a growth in size. And additionally, in terms of the growth in value indexes, the growth indexes are regaining, or Alphabet and Meta are rejoining fully the Russell 1000 growth index, meaning they will be the biggest deletions from the Russell 1000 value index on Reconstitution Day. And then also on the smaller cap side, some more energy companies with some of the volatility earlier this year are going into small cap value, the Russell 2000 value index.
Mike, from Nasdaq's perspective, why is the Russell Reconstitution so important for markets and investors?
Yeah, as Catherine mentioned, it's one of the biggest trading days of the year. You'll probably have a couple of hundred companies go either out of the Russell 2000 or 3000 or into it, and you have another dozen or so going from the 1 to the 2, and there's all other Russell indexes. And the weights of many companies that remain will also change. So you have you have over $1 trillion that's indexed to the index directly. And these changes have to be mirrored by ETF and index tracking investors. So all of those stocks have to be bought and sold. There's probably about $100 billion estimated in two-way flow, and all of that has to happen on the day of. So it's a very big and important day for the market.
Catherine, what role does transparency play in the Russell Reconstitution process?
Transparency is of utmost importance to make sure that the trading day on Russell Reconstitution Day goes smoothly. This year we started with the rank day at the end of April, and the preliminary announcement day of May 19th for the additions and deletions to the Russell indexes was earlier this year than in past years, and it's been welcomed by the market because it gives the market more time to prepare, and our objective and transparent methodology is a big part of preparing the markets for the trading that's expected to happen at the Russell Reconstitution close.
And Mike, back to the trading question part of that. What role does Russell's transparency play for that outcome?
It's super important because they're not springing surprises on the market. Because the index is transparent, the methodology is known by all market participants. Brokers, for example, can predict with a fair degree of accuracy the companies that might go in or out of the index. They can predict, and they try to almost to the share, how much will be bought or sold. And because of that, you can match up imbalances well in advance of the day of. And that helps, especially if you're a listed company, reduce the volatility, and it helps market participants offset the imbalances and take advantage of the liquidity that's provided.
Let's talk about fundamentals for a moment here, Simeon. Address the rebalance effects on the Russell 2000 Dividend Growth Index and the Russell 3000 Dividend Elite Index.
What's important here is that everybody become aware that indices are not just for the broad market representation anymore. In fact, from our perspective, they represent rules-based strategies. If you think about those Russell 2000 dividend growers, those are high-quality small caps. So let's say you had a view today that after a decade of outperformance, small caps are cheap. You also know that if you take the Russell 2000 off the shelf, it's kind of low quality. More than half the companies don't even make any money. But here with the Russell 2000 dividend growers, you've got consistent dividend growers. They make money, they grow their dividends, and it's a great way to deploy that and get exposure to small caps quality at a discount. But guess what? Because it's by rule, highlighted by that reconstitution, you're not at the whim of an active manager who might change their stripes at any given moment.
And Stephen, what does the Russell Reconstitution provide investors?
I think a couple of different things. One, you kind of mentioned about liquidity. There are going to be non-traditional players in the reconstitution trade, so it does provide a lot more liquidity for small cap investors, which generally don't particularly have a lot of liquidity. And so this is an opportunity to make some changes to the portfolio. And then again, it helps make the portfolios and give kind of a thought process around changing sector weights on, you mentioned overweights and underweights around healthcare and comm services, but again, you get your portfolio back into line with the benchmark. And the indexes actually change more toward, like the growth index is becoming more like a growth vehicle. The value index is becoming more cyclical. You kind of move back towards what kind of the intent of the indexes are. And again, to quarter back to the intent of what the strategies that you're investing in and managing.
Well, let's talk about that for a moment here, because really large cap has been the story for 2023. What are your thoughts around small and large cap performance? And Simeon, you can follow up on that as well.
So the problem is that we started out so well with small cap, and then we had March, we had the banking issue, and that's given it all back here. I think small is excessively cheap at this point relative to large caps. There's been a whole host of reasons why small should underperform, and a lot of that stuff is actually behind us now. Recession fears, well, it looks like the economy is doing better. Small cap should do really well in that environment. Earnings have come in much better than anticipated. Relative valuations look good. M&A activity has really picked up and accelerated. All the backdrop is really good for small to outperform. We've started to see a little bit of shift from a fund flow standpoint. And quite frankly, I do think reconstitution allows you an opportunity to kind of rethink your strategy. And again, the idea around more liquidity in the space really helps people out.
You get emphatic agreement from us. And after this over a decade of systemic underperformance, you're trading small caps 50 cents on the dollar to large cap on a price to book basis. But again, a little bit of the challenge is as you go down in cap, you pick up things like more leverage, and it might give you a little anxiety because they got floating rate debt and all that stuff. One approach is to use a rules-based strategy like the Russell 2000 dividend growers that can resolve some of those issues. So I'd encourage folks to think about the index reconstitution as an opportunity to look at the indices beyond just the Russell 2000 for some opportunities to maybe align a disciplined index and set of rules to achieve some of their objectives.
What about active versus passive performance, Steve?
So far this year, it hasn't been as good for active folks. Last 3 months have been much tougher. Large cap side has faced the issue around concentration of performance. You mentioned a little bit about lower quality. You've actually seen non-earners, low ROE companies actually outperform, which has been a real thorn in the side for active folks. But the last several years, down cap, we've seen much better performance. And again, to your point, it was more about, you're able to kind of make an assessment of what's higher quality, kind of avoid some of the stuff that has higher leverage. Active makes so much more sense down market cap these days.
Yeah, and Catherine, the volume that you spoke about before that takes place in just seconds at the close, does that concern FTSE at all?
No, not at all, because if you think back to Brexit, for example, which occurred the day before the reconstitution that year, we do know that the market participants are prepared for this event. You guys at Nasdaq, NYSE are prepared for the trading that's expected to occur at the close. And we do also have policies in place in case of market disruption, but in recent years we have not had to leverage those policies.
And finally, Michael, what's significant about the Nasdaq Closing Cross? How many shares do you expect? Notional value? We know it takes seconds. What's that like for you being on the desk and this just happens so quickly, massive volume?
Yeah, I'm glad you asked that. I mean, the Closing Cross is available every day for stocks, and it's it's not that the 4 o'clock trade sets your closing price. It's a very managed process. Nasdaq spends a lot of time thinking about how to make it as low volatility of an event as it can be. And we gather up all the buyers and sellers that want to trade at the close or want to access the liquidity at the close and allow people to offset imbalances. So particularly on a day where you have an index rebalance as big as the Russell, that's when you get these very large trades. Last year, as you noted, we traded 3.3 billion shares in 2 seconds. It was $64 billion worth of stock. The year before, we set the dollar volume record. It was $81 billion, all of which was 1.5 million orders in 2 seconds. So we do spend a lot of time making sure that that happens smoothly. And for market participants and listed companies, you're lowering the volatility and you're allowing people to access liquidity. So it's super important that we have that in place.
All right, Michael, Catherine, Simeon, Steven, thank you so much for joining us as always. And thanks for joining me for our annual Russell Reconstitution panel. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.